invite me to come up. I got to see my first snow of the year from as I landed into the Minneapolis airport. So St. Louis typically has 2 or 3 snows about this time of year, and we haven't had a one. But we did get 11 inches of rain in 2 days, so we kind of made up for it that way. The situation in St. Louis, I'll start off with this just because this is where I'm from, but we've really seen some significant flooding that we haven't seen ever in a lot of areas of specifically St. Louis. If you go just a little bit further up the Mississippi River, the 1993 flood was worse, but a lot of the Missouri River, Arkansas River, tributary rivers are at levels that have really never been seen or measured as high as they are now. So there's some serious issues there. But I'm not here to talk about the flood of St. Louis. I'm here to go over a couple of things. And honestly, I want to start off with, this meeting for me is a little bit different than what I typically do. I typically do 50 or 60 meetings a year. I'm very busy in December and January because that's one of the times when we're promoting the program we're going to talk about. But a normal meeting for me is me doing a market outlook and then talking about the program, and I'm usually the only one on the docket, and there might be a weather person in front of me or not. So it was actually a real treat for me to have Joe and Mark talk before me because they did all the heavy lifting. I don't really need to do much from a market outlook. They did a great job. I have a market outlook that I'm going to go through very little of it. I'm going to skip most of it, so you're going to see me go through probably 30 slides in 5 minutes because I only want to make a point on about 2 or 3 of them, because quite honestly, Mark and Joe did a great job of framing the fundamentals of the marketplace, going over some macros that are very important, and quite frankly, I agree with everything that they said. I was sitting over there listening intently to try to say, well, would I have said something differently? I have a cautious optimism about the markets myself, just as Joe was talking about. It's not a big bullish dollar type of a thought process, it's just cautious optimism. But I do want to make a few points before we get into the program, the JSA Select program at the end, which will not take very long. Overall, I think the presentation will only be 15 or 20 minutes. This is some dollar and currency information that's all been gone over. I think one of the points I wanted to make, and it's been made for the most part already, we're not in a demand-driven market from a price perspective. We're in a market of oversupply. We don't really have a demand problem. We're just not in a demand-driven market when it comes to price. We are in a supply-heavy market. A couple of points I've been making throughout the various presentations over the last couple of months with this particular slide is, this is a chart of corn demand, corn exports in particular, and where those exports come from. There's 2 points to this chart. One of them is the U.S.'s share in the blue line of total world exports for corn, and the other bar chart here is who makes up those exports. One of the things that's happened over the last 10 years is the build out of ethanol in the United States. We do at JSA a significant amount of ethanol business. And I probably should back up, and I should have started with this instead of my silly flood comment about 11 inches of rain. But John Stewart Associates is, as a group, we've got 14 different offices. It's a group of 5 that own the company. I'm one of those 5. We are a commercial brokerage company. We deal 99% with commercial entities. Ethanol plants, grain elevators, hog producers, cattle producers. For the most part, less than 1% of our business comes from a producer brokerage commission-based business. Our clients are people like UFC, not folks like you guys, producers. So we're a broker just like a lot of other brokers, but our client base is all commercial. We spend a lot of time kind of going through a lot of these macro fundamentals. The point I want to make with this particular slide is, if you just ignore the colors of these bars, this chart is going from the lower left to the upper right. It's increasing. That's corn exports to the world from all origins. It's an increasing demand chart. It's similar to a comment that was made earlier about population growth. The world is needing more and more and more corn, more and more soybeans every year. That's not the problem. We don't have a demand problem, we have a supply problem. The thing that's changed substantially in the last 5 years, 10 years in fact, is where that corn comes from. When you look at the top kind of purple dash line, that's the Black Sea, that's Russia, that's the Ukraine. You look at Brazil in the middle, that's red, the reddish color, the yellow is Argentina, and the blue is the United States. If you go back to the mid-90s, there were periods of time when over 80% of every bushel of corn that was traded from country A to country B, so something that counts as an export, came from the United States. Today, that is leveling off at about 40%. In 2012, that went below 20%. The biggest reason that happened is $5, $6, $7 corn was needed to satisfy the ethanol demand that was created in the United States. And then that supply to the world had to come from somewhere else. We ratcheted up our supply very, very quickly, just as $5, $6, $7 corn would do. $5 and $6 and $7 corn puts corn on 92, 93 million acres. But once that levels off, now we're dealing with the supply as the world has come back into balance. That world come back into balance by these other countries filling in the void that we created. One of the other points I wanted to make that is a hint of optimism is when corn was at, I'll use the term cost of production, but that number has changed over time. I'm not saying cost of production in the 90s. I'm just saying think of the last 20 years of break-even numbers. When you go back into the 90s and early 2000s, we were the world's #1 supplier of corn because our cost of production and our transportation system gave us an advantage to export that kind of volume and that high of a percentage of corn to the rest of the world. That went away with $5, $6, $7 corn. You could grow corn north of Moscow, Russia, and take it down to the Black Sea and swing it around to Japan cheaper than it could have came from the United States, Gulf of Mexico. That's not the case today. You now have corn in northern Brazil, even though they are building ports in the north off the Amazon, that when you file back after trucking values to the farm are under $2 a bushel. That's not the economics that those corn acres were grown under and expanded under the last 5 years. So not only am I looking at a cautiously optimistic picture in the next couple of years, because I think we've priced in so much of the bearishness of the supply and the supply side issues that we have that have been very well discussed already. We're also dealing with a very different set of economics all over the world. Just as quickly as some of these origins to the world have changed, they can also do some reverting back, partly because we're going to get back to some of the roots of our economic advantages around the world. With that being said, one of our key economic advantages in the United States, and has been this way for 50 years, is our transportation system. The ability for us to get from our production centers in the United States to the West Coast, to the Center Gulf, and so forth. At times in the 80s and 90s, you could take a bushel of corn, stick it on a barge in Savage, Minnesota, when the period of time when the river's open, and you could take it to New Orleans for 40 cents a bushel. Nowhere else in the world could you have done that for 40 cents a bushel. Today, you can take corn from St. Louis, Missouri. I'm just going to use that number because it's more applicable because Savage isn't open. But St. Louis, Missouri, you can take a bushel of corn from St. Louis to the Gulf of Mexico for 18 cents a bushel. Nowhere else in the world can you do that. 2 years ago, that same bushel of corn going out of St. Louis with over 1,000% barge freight was $1.10 a bushel to go that exact same river route. Things have changed dramatically, not only in our supply and demand of our production side of the corn, but it's also in the logistics around the world, and that's shifting. This chart, if we are to stay, which I'm not necessarily predicting this, but if we are going to stay with a 3 in front of corn for an extended period of time, this chart will start to look different. You will see the United States creep back into a higher percentage of world corn trade. It's one of the underlying benefits of the price range of corn that we have. So I wanted to make that point. This is a China slide. Don't worry about all the numbers, you can't see them. I didn't use 40 font like Mark did, so you can't read it anyway. But the bottom part here, this is China's feed grain demand. The other cautiously optimistic point that I want to make, and I'm going to skip most of the rest of the slides, is on this particular China feed grain chart. Everybody remembers the big rally in, well, most people will remember the big rally in 95, 96 when we went to $5 corn the first time. That was a rally driven by China. That was a rally driven by China buying 5.5 million tons of corn. It's the first time they were a significant world buyer of corn. We have seen since then, China has tapered off into the late 90s, early 2000s as being a very insignificant country when it comes to imports of feed grains. They did a lot of policy changes to spur on domestic growth, a lot of government-sponsored programs through artificial pricing means in order to increase the amount of corn that China grew themselves. And because of the expanded acreage in China, China's had 9 out of the last 10 years, they've produced a record crop internally, domestically. So you would think, going from the early 2000s and into 2009-10, when things changed, that if you're going to have a near record crop or record crop 9 out of 10 years, that you wouldn't have a lot of need for more imported feed grains from other parts of the world. And the fact is, they've actually needed significant amounts of imported feed grains. When you look at, when you look at this chart here, this is 25 million tons. Remember my 1995-96, when that happened in 1 year, that was 5 million tons. That's this line right here. When we went to $5 corn the first time because of China buying corn. China, in terms of all feed grains, today, this year, 15-16 year, is 25 million tons of total feed grains. Why am I saying total feed grains and not corn? The issue is China's buying significant tonnage of DDGs, significant tonnage of barley, significant tonnage of wheat, and they're buying their corn from the Ukraine. Again, it all ties into where they're getting it from and what they're using it for, but their demand picture is quite strong. Joe made the comment in the beginning about the Chinese economy growing 12, 13, 14%. That's exactly right 7, 8, 9 years ago. Today it's, I think, 5 to 6%. So it is a substantial slowdown in growth. The thing that's misleading about that on China is not the fact that they're slowing down, it's what they're slowing down in. When you look at all those measurements of growth that you hear on CNBC and Bloomberg all the time, it's manufacturing, it's various housing data that gets pulled into. It's a consumption of non-essential food items. It's a consumption of materials and energy and things like that. There are still just as many mouths to feed in China as there was 5 years ago. In fact, there's more. And the change into their 1-child to 2-child policies means that their growth rate will actually be increasing from a population standpoint. There's going to be more mouths to feed. So my point on China is, even though the news about China is negative from a financial standpoint, from a stock price standpoint, and a lot of their manufacturing data that everyone is getting really bearish about, they still had record soybean imports 2 out of the last 5 months. 5 of the top shipping months for Chinese soybeans have occurred in the calendar year 2015. Their demand is still very, very strong for things that are a necessity to them. Food. Okay, so the China story is negative. It's not necessarily as negative on the agricultural side. I'm going to skip a lot of this. It's all gone over very, very well. I did want to touch this slide for one point on basis, because Mark made a great comment about basis and why Nathan's not been 20 cents more than he should be. But corn basis in particular, when we get into a definition of basis, our group spends a tremendous amount of time talking about basis. If you were to look at one of our research decks of papers and so forth, it's all basis. It's all spreads and it's logistics. That's what we work with on our commercial clients. For the last 5 years, prior to this crop year, the average basis for a rail shipper in the east, and I'm going to use Indiana as an example, versus a rail shipper in the west, and the data that I collect on this is in Nebraska. It's a UP market in Nebraska, a CSX market in Indiana. The average basis difference over the last 5 years prior to this year was 5 cents. It went up and down about 5 cents, and it was usually a slight premium in the east. That is the effect of ethanol. If you go back pre-ethanol days, we had a lot more production in the west as a relationship to demand than we had in the east. The east was generally slightly deficit. The west was typically more surplus. You saw wider basis levels in the west. Ethanol, because we built them all over the Midwest, the plants, has flattened the basis from east to west. That's what we've had the last 5 years. This year is different. This year, because the production deficit was in the east, the production surplus was in the west, which is what this graph is showing, it is one of the explanations as to why the western basis is a little wider than you would typically see. This 271 million bushels over top of the state of Minnesota, that is 271 million more bushels of corn was grown this year in this state than last year. You look at Iowa, it's 127 million bushels more in Iowa this year than last year. And then look at where we are down. Illinois is down 418 million bushels, Indiana down 238. That difference in production is what's changed this basis dynamic east to west. And today, the basis spread from a rail loader in Indiana to a rail loader in Nebraska is about 50 cents. We've gone from 5 to 50. That's what changes in production do, even within the Corn Belt of the United States. So there are a lot of basis opportunities. I agree with that completely, and there are much more so now because of these disparities in production and how the market is trying to get grain from A to B. We've got a lot of ethanol plants in Indiana that are buying trains from Iowa and southern Minnesota. That hasn't happened for 5 years. It's happening today. That's the basis and the compensation of that extra rail and transportation cost doing its job. That's some ethanol stuff. We didn't mention, there wasn't anything mentioned too much specifically on funds, even though they were implied in a couple of comments, so I wanted to hit this chart, and then I'm done. The other point that I have optimism on is the fund positions. We specifically look at managed money. There's a couple different categories of funds. The index funds really don't matter. They have a rebalancing effect sometimes that is short term. Managed money is the quick movers in the market. They're the ones that carry significant volumes, and they go long and short, so they do have the most impact on price out of the whole managed money fund crowd. In the last 15 months, we've had 2 significant rallies in corn. Both of those rallies coincided, and I would even use the term were caused and exaggerated, certainly exaggerated, by a significant switch in the positions of managed money. If you go back to last fall, this is October, November, December of 2014, so we're going back like 15 months. The funds at that time had a record short position on. They were short at one point in time over 110,000 contracts of futures. And in a matter of about 2 months, they went from short 110,000 contracts to long over 275,000 contracts. In that 2-month period of time, which was from the beginning of October to the middle of December, we had a $1.02 rally in corn. Last summer was the second one. Last summer, we made a new record low, new record short by the managed money crowd. It was about 179, 180,000 contracts that we were short in early June, the we meaning the managed money group. In a much quicker, much more violent period of time with extremely high volume. We had a week in there where we had 3 record volume days in the same week on the Chicago Board of Trade. But we went from short 179,000 contracts to long over 230 in about 4 weeks, 4 to 5 weeks. That coincided with an 88-cent rally in the market. Where are we at today? Today we've just matched, as of Monday, which was the Commitment of Traders report, we matched the low, or the short position managed money had back in about 15 months ago, and I would not be surprised if the next Commitment of Traders report comes out, shows them getting even shorter, almost to the point of a record short position. The trick with this particular comment trying to come off as bullish is there needs to be a catalyst. It's very, very difficult today to look out in the marketplace and say, that's the reason I want to be bullish. I can't point to a fundamental thing today that says, I want to be bullish because of that. I can point to a market situation, which is how short the funds are, and I can say, when we see something that's bullish, and that causes this group to get spooked a little bit, the reaction can be pretty significant with them getting out of their short position in a very short amount of time. That plays right into the marketing plan thoughts that Mark had on seasonals when it may happen and having some targets in place. That's the opportunity to put floors in, different things like that in your marketing plan. I fully believe sometime between now and through the pollination period, we're going to have some sort of event in the market, whether it's weather related or dollar related or geopolitically related, that's going to scare this short group into going long. And that's going to be an opportunity for us in the marketplace. Every single category of trader, when you look at all the different categories of traders, if I exclude the index funds because they can't be short, when you look at all the different other categories, they're short. There's one huge, huge long in the building, and that long is in this building, okay? And it's not just in this building, it's in the same building in Brazil, and it's in the same building in Argentina. The more significant long is in the United States. It's not, we're in pre-harvest periods of time in South America. The market really, I mean, one of the things that I was thinking about this during the previous 2 presentations, One of the things the market really would love to know is, when is that point in time, and it was referenced as when the banker says you need money for cash flow purposes. The market knows where this long is at. They know it's in your hands, whether it's in the elevator, in your bin, or in your ownership in one way or another. It's unpriced. When do you, the producer, as a group in the country, need to start flushing this grain onto the marketplace? Last year, there was quite a bit of staying power. It stayed all the way into the summer. This year, I don't know if it lasts all the way into the summer. We may see a period of time when these funds are starting to unwind shorts, but it happens at the exact same time that we're seeing a lot of producers move corn onto the marketplace. So the impact might not be 88 cents. It might only be half of that, but it's still going to have an impact. The point I have is, even though there might be significant buying from the funds here at some point in time, that's also going to be met with significant selling. So I just wanted to put the caveat, I'm not saying we've got a 90% rally coming. It might only be 45 or 50 cents, just simply because of how long this group is around the world. So, wanted to put a plug in there on the fund side. I don't have anything on beans to add. It was very well gone over. No, I don't need to go over that. That was fine. Same thing on bean funds, $1.30 rally last summer. The same comments I had on corn. It's just a matter of identifying when that group is moving. That's going to be an opportunity for you to come in and do some, put some action to your marketing plan. Okay, that's all the little points I wanted to make on the outlook. The JSA Select pricing program, I want to give a little bit of history. It'll take about a minute. And because I'm going to spend a little bit more time than I do going over how we look at this program instead of just explaining it, and I'm going to go off script here a little bit. But the JSA program has actually been around since 2002. Okay, it started as a program that ADM offered to their customers at ADM grain locations and ADM plants. And John Stewart, at the time, John himself was the president of the company. That contract was an exclusive contract. It could only be done with ADM. So from 2002 to 2012, actually 13, the 13-14 crop was when it was different, but to 2013, this program existed pretty much in the form that it is today, but it was only housed within ADM. It was an exclusive contract. We couldn't offer it outside anywhere else. We didn't price anybody else's bushels that was doing business with anybody other than ADM. In 2013, which was actually several years after John Stewart retired himself, John himself has been retired for 6 or 7 years now, we finally were able to separate ourselves from ADM. Not that there was any issues, but there's been a need growing, especially the last couple of years, for us to try to do this program outside of the umbrella of ADM. So John Stewart created a company that is just him personally, and he still has a program with ADM, but it is not the JSA program, even though JSA comes from his name. It has nothing to do with him anymore. So we've been offering this JSA Select pricing program for the last 3 years without anything to do with ADM. So that's kind of the history of it. I've only got a couple of years of price history because I don't want to put the ADM history up there. I don't know that that's fair. But basically, as Nate said in the beginning, this is a managed bushel program. It's not a novel program. There are many of these out there. Some of the more alternative cash grain marketing programs probably come through the Cargill shop. As much as any other company, they have a program with their Cargill pros. It's very similar in design to any other professionally managed pool program. This is the group. This is who we are. 5 out of the 6 of these guys are the owners of the company. The guy in the lower right is not. When it comes down to us, who essentially, by you signing up for this program, you're entrusting us to do the best job that we can through all the tools we have available, and I'll explain those tools, to price, in the end, the highest price that we can, the highest short position that we can attain in a particular pricing window for bushels that will eventually be, for a price that will eventually be the futures price on your contract to UFC. So in a nutshell, that's what the program is. This is the group. It's not one person. We don't. It's a majority rules, and I don't want to diminish the old gunner here. But the 5 here, 3 on the left, 2 on the upper right. The 5 of us get together all the time, Gunner's involved, but we will talk, and we talk almost daily, okay, about this program. Do we want to be doing anything different? Do we want to be adding anything? Do we want to be doing anything with options? But it's a majority rules. If we have a strategy that we want to sell 20%, if we achieve 410 on beast corn from a future standpoint, 3 out of the 5 of us say yes, that's what we want to do. Then that's an order that we're going to have working. So this is the group. The other reason I have it up here is to point out that I'm actually one of the young guys. This says 19, it's up to 20 now, 20 years of experience, but you've got 37, 30, 32, and then Brent's about the same age I am. The other point to this isn't just our age, but it's also, we've all come through commercial trading channels. We're all brokers today. None of us started as brokers. I've spent all but the last 4 years of my career working at ethanol companies and companies like ADM as a trader in various forms. We've got an old Continental Grain, we've got CHS, we've got CGB, we've got Bunge. All the experience of these commercial companies are within our group. I don't know that that gives us any more of a key to the kingdom on pricing than anything else, but it's just a pretty well diversified group with a lot of different experiences other than just being a broker forever. That's really not our company or our group at all. The key features of the program, you guys know more about this, and so I have a couple slides that might be not as necessary, but it's simply, Nathan brought it up before about a diversified approach. It's very important to have different irons in the fire when it comes to your marketing program. There's a chance that some are going to be certainly more successful than others, but having some diversification in that decision-making process for marketing we feel is important. It's important for your 401k. It's important for your corn and soybean marketing plans. We are a third party. That's one of the things that makes us different from someone like a Cargo Pros program or a CHS program. We're completely outside of the cash arrangement. This is a cash contract that's between you and UFC. We're not a party of that contract at all. We're a third party marketer who is simply doing the best that we can. And I do think we have about 25 other commercial entities in this throughout the entire Midwest. We have Michigan, Ohio, Indiana, Illinois, Missouri, Iowa, Nebraska, and Minnesota. We have clients in these programs in all of those states, and in most of those states we have 3 or 4, as many as 7 or 8 clients in some of those states. It gives us a little bit of a unique perspective because if you take a look at last year, it was a perfect example. It was probably easier in the state of Minnesota in the first week of July to let go of some corn because you guys were looking at a pretty good corn crop out your back door when we had that rally going on. In Indiana, they didn't sell a bushel because they're looking at a crop that's got 2 foot of water in their fields and a bean crop they don't even know when they're going to get planted. And they're sitting there saying, well, it's about time the market realized that we've got issues. But what the broader market realized was those issues were pretty much confined to the state of Indiana, and everywhere else was pretty impressive. So us having a broad look at the, it gives us a pretty good perspective of local problems versus something like 2012, which was an entire Corn Belt issue. 100% of your bushels get priced. This is not an option embedded contract where you have double ups or knockouts or accumulators or anything like that. This is simply you putting in 5,000 bushels, and at the end of the pricing period, and you want to deliver it in the fall, we're going to be charged with doing the best we can to set the futures price on that contract, and you'll have 5,000 bushels on an HTA when it's over. I already mentioned the number 4. We can reprice the entire pool of bushels up to 3 times. So this is going to get into some of the parameters and how we look at this program. Every single commercial entity that we deal with has a pool of bushels. I don't see, nor do I quite frankly want to see, any of your producer contracts. I have no idea. At the end of this thing, Nate's going to come to me and he's going to say, you know what, we've got 300,000 bushels of corn and 150,000 bushels of beans. That's all I see. That's all I know. That's the pool I have to work with for UFC in Minnesota, right here. I'm going to have 25 other pools that are like that. So I'm looking at it as one big pool made up of a lot of other pools. We can price and reprice using futures and options that entire pool up to 3 times. So we can sell it, we can re-own it, sell it again, up to 3 times. We use options. We use options quite a bit. And I don't want to step on the toes of the things that Mark was saying by this next comment, because we're using it in two different ways. But my comment is, I absolutely hate buying options. I don't buy calls, I don't buy puts, with the exception of some extreme situations. They're very short-term deals. The reason is because of the application that we use for those options. And it also shows you that we're not a producer brokerage firm. I mean, when you look at the buying of puts to put in a floor, that's a very sound marketing strategy. It's not something we use a lot with this program. It's also, buying calls. We don't look at buying calls necessarily as a hedge for a producer because you're already long, you're getting longer. So buying calls is something that we, quite frankly, never done in this particular program. On the opposite side of that, we absolutely love selling options. We sell a fair amount of them. We look at options as a way to continue to add some premium to the price along the way. So when it comes to our marketing strategy and our approach with how we ultimately derive at the price we do in the end, a big part of it is selling options. What we do is we create a range, and that range does change from time to time, but we create a range over a pricing period of where we think corn and beans could go. High end of the range, low end of the range. That is not an arbitrary thing that we set. We set that up by going into our database, which goes back to 1965, and we take every single crop year of corn and beans back to 65 and we rank them. And we split them into two different categories. One category is years in which the ending stocks as a percent of total use increased, and the other bucket is the ending stocks as a percent of total use decreased. So we have two groupings of years that are 45 years in total. And then we rank them from top to bottom. And then we insert the current crop year and say, how does it stack up to history? What are some years that are very much like the year we're looking at? Not in absolute price terms, but in terms of about 5 or 6 different categories: exports as a percent of production, U.S. percent of world trade, South American production of soybeans as a percent of world trade. We have a lot of different categories that we rank them with to try to see what years are very similar in the past. It might be 1972. 1972, the price might be $2, but we convert that into today's dollars, and we create the range from there. That gives us a high-low range, and that range is what we use on the low end to sell puts, on the high end to sell calls, and then when we feel like we've reached some seasonal levels, which just feeds perfectly into what Mark said. We believe very strongly in seasonals. When we get to where we think we're more at a seasonal high, and we're on the higher end of our range, we're going to get much more aggressive in pricing in that period of time. Locking in the futures, not just options. As a producer, you need to be short if you're hedging. So our position always has to be short, to some degree. So we can't just go buy puts. If I had a strategy today that I was just trying to make money on, it would actually be to sell puts, because I do think we're more near the bottom. I can't go into this program and just sell puts. That's a long position. A long is not a hedge for a producer. I love selling calls. The reason I like selling calls, especially if we get on the higher side of the range, is I almost hope to be wrong. It's one of those positions where when you're wrong, it's a good thing. I'll sell a $4 call, a $4.10 call, a $4.20 call. If that position's out of the money, that means the market's continuing to go higher. And that's going to give me an opportunity to lock in the futures. So we tend to weight ourselves much more heavily on selling calls than selling puts, but we like to balance them, especially when the market is as boring as it is right now. You can sell both of them and probably make money in the short run. We give bi-weekly updates. We tell you what we're doing. We tell you exactly what we're doing all the time. Every 2 weeks, you're going to see where we're at. You're going to see what positions we have on. It comes through UFC. They forward it out to you all. All of the positions are in UFC's account. We don't have some big master lock on an account that nobody knows what we're doing. Nathan knows exactly what we're doing every time we do it. It's a fully transparent program. These are the pricing windows. Nathan has already gone through those, delivery windows. All of these programs, I don't care which one you're talking about, there's dozens of them out in the country today. Most of it comes down to performance. How have you done? How have you stacked up? There's some differences, but at the end of the day, what did you achieve? This is the last 2 years. We're working on a third right now of how we grade ourselves. So if you look at December corn, so this is the fall delivery period for corn and beans. You look at the 2014 crop, so this is last year. The futures price that we achieved was $4.39. the average price in October of the December future. So this is every close in October, and its average was 349.5. We compare what we achieve to the most common delivery period within that delivery window, and in this case it's October. When we look at the winter delivery, we'll look at January. And I'm not going to lie to you, we're going to be pricing in a period of time that we look at seasonal highs. When we think about Mark's seasonal charts, and we're comparing ourselves at an October average, which is, by the way, a seasonal low. So we know that. I mean, is that dressing up our performance? Maybe, but it's also showing the marketing patterns of a lot of the producers, and our goal is to get you out of that pattern into something that's perhaps more profitable. So we're forcing ourselves to price ourselves much earlier than that and comparing it to something that would be a spot sale over the scale. Look at beans for 2014. November beans, 1146 was our futures price last year. The average in October for November bean futures was 964. This year we were 415 compared to the average of 383 for these futures, and beans 944 at 890 and 891. Those were the October averages for the fall program. You look at the winter, we were 444 last year, last January. 388 was the average. Beans 1195 versus 1002. We were 452 this year for March corn futures. So a lot of the contracts we did last year that will be for delivery about now. The futures price is 452. I don't know what the January average is. We're in the middle of it. And then 970 for beans. I probably need to take a cue from the previous two presentations, because my disclaimer is at the end and it probably should be in the beginning. But the same legal verbiage that the other two gentlemen have said is the same thing that I have at the end of this presentation, which has to do with past performance is not indicative of future performance. This is what we've done the last 2 years. It's no more than that, it's no less than that. Most of what you will see from us, we don't usually get too aggressive early on, February, March timeframe. We get very aggressive May, June, in trying to price some things. The other thing that we use a lot is, I've already said options, but it's not just the full length options, like December corn and November beans. One of the best things the Chicago Board of Trade's done in the last several years, in my opinion, is come up with a short-dated option where you can actually price a harvest delivery December or November bean contract, but you can have multiple expirations of that contract through the old crop year into the new crop year. So you can actually trade, we can't trade all 6 of them, but we can trade 4 different time frames of options for the same fall bushels. That's 4 time decay curves. That's 4 opportunities to put some premium in our pocket, and we try to take advantage of that as best we can. So we do utilize a lot of those short-dated options. Like I say, I'm kind of off script here because of the different setup of this, but that's the high points I wanted to go over. I think, like I say, that the 2 guys in front of me did such a great job. I didn't have to do a whole lot of the heavy lifting, so and they're a little more funny than I was too, because I didn't have any jokes. I didn't know I had to have jokes. You guys are, require jokes. Nathan didn't tell me that it was a prereq for the meeting, but, and you don't want me to think of one just off the cuff. It'll be something about something on a board that I shouldn't say. Maybe we'll call that a joke. Any questions? Anything that I have, or anything about the program? Again, I think the 2 guys in front of me did a great job. I mean, it really mirrors my thought process very well, so I don't have a lot of contradictory things. Yes, sir.
Brian, why do you think that the spreads are so narrow right now? I mean,
it's a great question. Your slide on spreads and Nathan's comment about how they're much narrower than you would think, given the set of fundamentals that we have, has really only one explanation, and it's ethanol. And it's ethanol on top of the tight holding of the farmer. Spreads are not determined necessarily by the size of the crop, even though that's a key component of it. It's determined much more by the size of and the percentage of that crop that is priced and available to the market. So if companies like UFC and all others around the country were sitting on significant ownership of corn, millions of bushels per facility, if they owned a lot of that corn, the spreads would be substantially wider. The fact is that we don't. There are places east of the Mississippi River that are short corn, probably as many short corn as long right now. So that's part of it, is the available corn to the market that has been priced is much smaller in percentage terms of the crop that we had. The other factor is maybe a little bit more technical, and that is our delivery system goes up and down the Illinois River, and that delivery system has worked very, very well since about 2000 to about 4 or 5 years ago, as representing the cash markets and the carrying charges that were warranted by that cash market. The thing that's changed is we've built a bunch of ethanol plants along that Illinois River system. So a delivery system that's based off of the SIF market or the export market, barge freight, and the river bids is different than maybe an ethanol plant that's 5 miles away bidding 30 cents more than that river market is. So that guy on the river is not going to deliver corn because he's got to go source that corn against an ethanol plant that's outbidding him by 30 cents. That artificially narrows the spreads, in particular on corn. That's changing. The CME is going to take the delivery system down to St. Louis, which will help. There's been a working group on that. I think that's going to happen. They have to do it so far ahead because they have to go to the next contract that's not open yet, which is 2019. But I think that's going to happen. So for the last 4 or 5 years, we've had very underperforming spreads. And what I mean by underperforming is they haven't gotten as wide or paid as much carry as if that same set of fundamentals would have happened prior to the big ethanol build-out. The ethanol demand that's constant every single day, taking 5 billion bushels of corn out of here on an annual basis from Nebraska to Ohio, is narrowing up those spreads also because of them being located right on top of the delivery system. There was one over here also.
Has your average price ever been lower than the fall delivery?
Yes, absolutely. Not as JSA Select since we've taken it out of ADM, but in the ADM program, which is they call it ADM Advantage. That ADM Advantage program, this is year 14 for that program, and there have been 3 years out of 14. 2 of those years were actually less than 10 cents below. One of them was the year 2010 when we set highs in September or October. We were out by like 80 cents. But we had a very late counter-seasonal rally that particular year. I'm not trying to explain it, I'm just telling you the results. But yes, and it can happen. There is no guarantees. Beans, we've actually had 4 out of the 14. The results of the last 2 years, we haven't, but again, that's only 2 years. I don't really want to put too much stress or put too much emphasis on the last 2 years because we've had relatively seasonal price patterns that we follow. We've had relatively non-volatile markets where you kind of get yourself out of bounds, and it's only 2 years. I mean, 2 years doesn't make a trend. Any other questions? Yes, sir.
Yeah, you had a slide up there about exporting things into China. Do you think China is going to be exporting more ethanol? I mean, all the pictures you see on television, they're all wearing masks and their air quality is poor. Do you think there's a future? I mean, you had feedstocks.
That's feedstocks.
Yeah, but I mean, do you think ethanol has a future of being imported into or exported into
I'm not
China?
sure if everyone can hear the question, but it's about like ethanol demand in China, especially from an air quality standpoint. Nowhere in the world today is the air quality impact and some of the positive environmental things recognized in ethanol than it is in the United States. So, and I'm not saying we fully recognize it here very well. I mean, around the world, ethanol is viewed as a substitute for gasoline, as a substitute for a motor fuel, and as an octane agent. In the United States, it's all of those things, plus we require it through an RFS mandate, and some of the air quality features that it has. So we've layered on top of some of those benefits. Interestingly, China in the last 4 or 5 months has showed up as a pretty significant importer of U.S. ethanol. We are selling them ethanol today. China does have a severe environmental problem. How severe it is depends on where you're at, what part of the cities, and what type of pollution we're talking about. Their water pollution is probably the worst, but then their air is second. So do I think that them being a significant user of ethanol is something, multiple years in the making, yes. It's not gonna be anything immediate. But I think that's one of the future spots that we could say, okay, what's gonna cause us to have a demand-led rally?
That's what I'm getting.
Okay, supply rallies, spiky, shallow, everything that's been said already is absolutely true. Demand rallies, 4, 5, 6 years in the making, peaking out in a much longer lasting type of rally. I don't know that that can be the catalyst for it, but it can certainly be one of a couple of things. So this is a feed grain import chart, and what my point with this chart is to show their strength in their feed grain demand, because their soybean demand is a well-documented thing. Everybody talks about China soybeans because they're buying 85 million tons of them, or whatever that number is, 80 million tons, which is a massive amount of soybeans. But quietly, they're also bringing in 25 million tons of feed grains today, which is not talked about that much because it comes in different forms, and it's really not coming from the United States except for DDGs. So that's an undertone of demand that the market's missing, and that was really the point of the slide. But ethanol's a part of that. It's a part of it, but it's a small part today. Any other questions? We've been here on the really comfortable chairs for a couple hours. Okay, thank you.